My name's Brandon, and I'm with a group called Invested Interest. Invested Interest is a website group of financial advisors, kind of web-savvy tech kind of guys who are interested in providing social investing information for a younger generation, which, just by looking at everybody, kind of this generation, 20, 30, 40-year-old. So kind of sexing up social investing a little bit, making it a little more interesting and fun. On our website, we provide things like free tools that you wouldn't be able to find anywhere else to help you make social investing decisions on your own. Kind of news articles, kind of where the current trends and events are in social investing. I've been doing this for about 8 years. I have around 100 clients. Most of those are social investors. And when I was younger, just graduating school, kind of my personal story is I was torn between I really enjoyed finance, but at the same time I wanted to, kind of do something good, something I could sleep well at night. Just through time I've progressed to social investing. I kind of found it on my own, though, through general finance and providing financial services. So I put that out there after the presentation. If any of you are kind of in that same position right now and you're wondering, how do I reconcile these types of feelings and what I want to do with life, I could speak to that. And being younger, I can kind of provide a unique perspective on our generation, our perception of social investing, what we demand out of returns, the types of social investing products that are out there. And then finally, right now, Invested Interest is providing all the social investing content for the Net Impact website. That's something that we just started doing a couple months ago. So if anybody has seen that and has any recommendations or would like to talk about that, we've begun that relationship recently, and we'll continue doing that for going forward. So I'll let Pierre introduce himself personally.
Hi everyone. Pierre Trevet, I'm French, as my name indicates. I've been in the industry of sustainability investing for a bit more than 10 years now. My background is in engineering, but I have a passion for corporate sustainability, most precisely environmental sustainability. I've been with Innovest for 6 years now, working both as an analyst and then starting business development. I was recently I implemented the activities of Innovest in continental Europe with offices in Paris. And so I'm very proud to be working with this firm that has been growing quite rapidly in the last 7 years. We're a little north of about 50 professionals, more than 40 analysts. We have offices in many countries, headquartered in New York, offices in Toronto, London, Paris, Madrid, Melbourne, a partner in Stockholm, Rome, and a distributor in Japan. So our coverage is the MSCI world, and we, I will talk about, we're not really an SRI player in that sense. We would consider ourselves as more of a financial advisory firm with a specialization in analyzing non-traditional factors of performance, of risk, opportunities, quality of management, and governance, and with a specialty in analyzing those sustainability drivers. So with that, I'll let the floor to Brandon to introduce the space in the U.S.
Yeah. So I think I'm ready to start a slide presentation. I know we were told not to have too many PowerPoint slides. So of course, Pierre and I put quite a few PowerPoint slides together, but just the PowerPoint slide is going to be kind of a additional information on what I'm talking about. I'm not just going to read off of it. But if I do not talk about something, you guys have a question, just jot it down. When we get the question and answer, you guys can ask me about something. Just kind of give you an overview before I get started. I know you didn't come here for kind of a history lesson, but I'm not sure where everybody's experience with social investing is at. So what I'm going to do is I'm going to, quick nutshell, 2 minutes, just kind of bring up to speed a couple events in the history of the United States and the history of the world in financial matters, kind of how we've gotten where we are right now in social investing. Then we're all kind of on the same page. And then from there, talk about kind of the predominant social issues. The way that American investors look at social investing today is what I see as like the trends across all the products and services. There's something called the 3 pillars of social investing that we can talk about. And then from there, really getting into like specific products, like the how-tos. That's what I do. I'm kind of the nuts and bolts financial advisor. And then from there, hopefully you guys will jot some things down, we'll have some questions. So I'll begin. And so, of course, the idea was to talk about how we got to where we are in the United States in social investing. So I decided to pick somebody who isn't in the United States or never was. John Wesley was one of the founders of the Methodist Church. So the reason I'm pulling this up, this was a long time ago, and a matter of fact, throughout all of history, there's been mention of money by religious leaders, by different religions. But John Wesley was really one of the first people to write. He wrote a sermon called "The Use of Money" about the ills of poor investments, about how investments can harm. I think he referred to like streams and rivers around us, it definitely was one of the first instances where somebody made a methodical, him being a Methodist, approach and documentation of social investing and the ills of, like I said, poor investing. And he was alive in the 1700s, so you can kind of see this starts a long time ago. From John Wesley, I'm going to jump a few hundred years to the Vietnam War. And the reason I point this out, I really see the Vietnam War in the history of the United States as the beginning of kind of modern social investing. So investing around an issue, around a company, and a product that they sell. So Dow Chemical created 2 products that are fairly notorious, napalm and Agent Orange, during the Vietnam War. One of the interesting things is the first reaction of Dow Chemical when people were protesting. And actually, students at Berkeley, students around the country, when Dow Chemical recruiters were coming to their schools, actually protested against the recruiters. So there's this real direct connection between Dow and this product that hadn't really been made before with other products in the history. And I don't know if you guys can see. Everybody, it's a horrible picture. I put it there for just to remind us. This is the product, and this is really one of the pictures and images that seared into the American public's mind. An American company made this product that did this. I think there's a real kind of watershed in the history of social investing that there is a direct connection between a product and a company's culpability. And Dow Chemical initially said it was the Pentagon's fault because they used the product. They just made it for the Pentagon. But I think history would show that the American public really didn't buy that. And the protest against Dow during the Vietnam War kind of bore that out. And from the Vietnam War, moving to the end of the 70s, the issue of apartheid kind of became primary issue in social investing. There was a gentleman by the name of Leon Sullivan who at the time was a board member at General Motors. And the issue of apartheid, and even people who are like casually familiar with social investing, was one of the first times in international history, financial history, that a single issue prompted different players throughout the world, throughout the capital markets, to focus on a specific issue and bring their financial leverage and pressure to bear against that issue. So colleges, pension funds, individual investors were all involved in divesting or removing their investments from companies that were involved in business in South Africa. And so that's the history that I wanted to bring you up to speed. And my feeling, looking back at the history, and also I'm taking a lot of liberty in using a lot of information, not necessarily in a direct sense, but that other people who are writing about social investing in the United States today, kind of the map and the progression that they have also seen. But for me personally, I see this kind of leading to, and this is a trend I see in social investing today, this real tie to ownership. And I think this is going to be real interesting when Pierre talks, because I think Pierre will talk about the use of social investing in kind of a capital market sense. Where I see in the United States, there's a lot of focus on ownership and not in my backyard, not in my portfolio type mentality with social investing. And that in many ways, that's the predominant strategy and understanding of what a social investment is. And this runs the gambit from religiously screened investments all the way to real green and liberal type investments. It's a I don't want to own it, I don't want to be a part of it type of mentality. And also through history, social investing has really become kind of at least in the United States, is a real activist approach to social investing. And today, the most cited kind of structure for social investing is called the 3 pillars of SRI. And when I see the 3 pillars and hear mention of this, it's meant to be a framework to provide just general social change through investment. There are different types of strategies, but the goal is kind of like for lack of a better, an activist. We're trying to change the world, and here's like a 3-pronged approach to do that. And just to kind of give you a brief rundown, this will come up when we're talking about the products that are available today. You have the strategy to divest or to remove your investment from companies that are violating social preferences that you may have, and this is called screening or negative screening. So, for instance, if you do not want to be involved in companies that were harming the environment, perhaps a negative screen would remove oil companies, remove timber companies from your portfolio. The second pillar that's often described and talked about is the shareholder resolutions. I think there was another panel discussion at this conference about shareholder resolutions. This would involve actually buying stock or owning part of the company that you want to change. So you would actively find a company that is violating a social issue or doing something that you, on a personal value level, don't agree with. And by owning that company, you're able to propose shareholder resolutions that are then voted up or down at shareholder meetings. So you're able to perhaps change the company from within by owning a part of the company. And the third, and I'm not going to really get into this all that much in this presentation. It's a very involved topic, but community investing, investments that are directly benefiting a underdeveloped or underserved community. So, for instance, like a financial institution that makes underrate loans to individuals, small businesses that otherwise wouldn't be able to get loans. Or they work in communities that are being overlooked by traditional banks or financial institutions. So together, these 3 pillars of SRI today really drive all the products and services that are available to a social investor. And like I said, I really do see this kind of coming from an understanding of ownership being the primary purpose and role of social investing, and kind of like I said, an activist strategy. So this is really like a 3-pronged approach. Here's something, and I think Pierre also has this in his, so if you don't get it, it'll be coming back around. SRI Trends in the United States, this is as of 2003, and provided by the Social Investment Forum, which is one of the online resources that anybody can use for social investing. And as you can see, the 3 types of social investments, of the 3 pillars that we were talking about, how much money is actually going into these types of investments today, or today as of 2003 in the United States. And get into some of the investments that are available today. And, as you guys hear things and have questions, just jot them down. This is probably the part that we'll expand upon when the question and answer stuff comes around. But I'm just going to I'm going to go through it quickly now, but this is definitely the part of the presentation that we can talk more about. And just a fact, in 2003, over $2.16 trillion in the United States was invested in socially screened investments. And that includes pension funds, endowments, and individual investments. And since 1997, SRI, or screen funds, has grown 240%. And actually, social investing is the fastest growing segment of the financial services industry. And so as far as hitching yourself to something that's growing, social investing definitely is growing. And I think some of the things that Pierre is going to talk about is probably the reason why it's growing the fastest, is when it's proven that social investing can increase returns or lower volatility. I think you really have capital markets behind you. You have large pension funds, endowments jumping on board. Some of the products that are available today, you have social mutual funds. So for the casual investor, this is the standard mutual fund. The additional service that's being provided is that screens are being applied to different types of mutual funds or asset classes. So you have, in the world of social mutual funds, there's over 100 today available. You have large domestic, you have international, small cap, bond, blend, balanced funds, everything that you would want as an investor. And you'll have different types of screens, and it'll usually be like a mix of screens. You'll have like 3, 4, 5 different objectives of the fund. So environment, board diversity, child labor, tobacco. These are some of the screens that will come up. The only thing when investing in a social mutual fund is a lot of times an investor will be making maybe a small compromise as far as the types of issues they're concerned with, the way that those issues are being addressed. And so going back to like the 3 pillars or the 3 strategies in social investing today. So some mutual funds will actively invest in tobacco companies in an attempt to change those tobacco companies. Some will screen out tobacco companies. So there's different ways that these mutual funds are addressing these issues. And one thing that we can talk about, there's been articles even within the past year about the way, and for instance, I think it was the Sierra funds, the way that they were addressing environmental issues within their funds became an issue. And like I said, it's something that we can talk about. It's really kind of it's something where when I'm advising people, you must read the prospectus. You must know what you're kind of getting into. They usually spell out exactly the way that they're going to address these social issues. But it is something that creates a lot of confusion, and I think unnecessarily in social investing today. But it does remain. Another option that you would actually just talking a little bit more about mutual funds. I mean, one of the reasons people get into mutual funds is because you're hiring a professional manager to invest your money. And with social funds, it's nice because you're also hiring somebody to apply these social screens. The social data today is very expensive and time-consuming to find. Pierre just mentioned that 40-some analysts at Innovest. There's only a handful of companies that do comprehensive social screening information on publicly held companies in the United States. And to get this data is very expensive. So for the individual investor, the time it would take, the actual money it would cost to find these screens is very expensive. And a cheap and efficient way to get the results of all the work that these groups are doing would be to invest in a mutual fund that has purchased that social information. Obviously by buying mutual funds, also you're hiring a manager to go out and grow your money competitively. It's something that's kind of off your table as an investor also. But with mutual funds, you have higher fees. Some social funds have higher than normal fees. Some of them justify those higher fees because they're buying social information or the added effort of screening investments on your behalf. But some are competitively priced, and that's something that every investor should look at. Another way to... I just skipped through a couple, but we'll all catch up here in a minute. Another way to get involved in social investing is to talk to a social investment advisor. So somebody who specializes in social investing. And once again, the benefit of that would be, a lot of times social advisors will purchase this social information, so they could recommend, if you came to them and said, I'm interested in buying Microsoft, I'm interested in buying X and Y, Z company, they would have the information that you would need as an investor to say, yeah, that is or is not a company that's passing social screens that you're interested in. And in addition, obviously working with an investment advisor, you have the benefit of somebody helping you build portfolios, helping you plan for retirement, college savings, all those types of issues that come up. And advisors have their own fees. Some charge hourly rates, some charge yearly assets under management, some receive commissions for the products that they put you in. The third way, and I think I kind of touched upon this when I was talking about mutual funds, would be to invest in individual securities on your own. So building a portfolio of companies, 20, 30 different stocks, and then screening them yourselves. And kind of getting back to what I was talking about mutual funds, the information and the amount of research that you would have to do, it really makes buying individual companies and screening them and then staying up to date, because things change. A lot of companies that are failing or passing certain social issues, it may not be next month, next year. It's a lot of effort for somebody to do on their own. It can be done, but it's definitely a cost of doing this on your own. In addition, just a straight financial sense, investing on your own in individual companies, if this was your retirement account, having 2 different stocks that you own, even though they are stocks that meet the values that you have and social preference that you have, isn't probably a financially smart thing to do unless you're a sophisticated investor. And let's see. Here are a couple sources of social information. You guys may want to jot it down, or I think we're going to publish these slides and the presentation online, so you can always go back. And I put links in on every page that I could. For information on social mutual funds, on our site, Invested Interest and the Social Investment Forum, we have the full list of every mutual fund that's available. You can search by different screening types. You can search by performance or asset class. So it's a good tool for the individual investor who wants to go the route of mutual funds and kind of do it on their own, but definitely, not completely on their own. They still want to use a mutual fund. Calvert, Citizens, Domini. Now, these aren't the only 3 companies that have mutual funds, but they're definitely 3 of the largest and most recognized. And I didn't feel at all worried putting their name up. They're reputable organizations. Shareholder resolutions, a couple of organizations that you can contact to get involved. And like I said, the community investments is definitely a topic unto its own. But a good place to start would be the communityinvest.org, which you can also find through, if you guys are familiar with the Co-op America website and the Co-op America group. You can find it through their website. It's actually part of their firm. And just kind of getting back, and actually these notes I wrote just 2 days ago. I was listening to Lloyd Kurtz is somebody that I've talked to, and who is probably one of the he's probably the walking encyclopedia of all social research in the world. And he was talking on NPR about this conference and had mentioned that he feels today cumulative social research has shown there's definitely a correlation between profits and social business practices. But I think the causation is still up in the air and maybe either needs to be proven or is something that's still being worked on. I just wanted to put that up there. I mean, it's something that we can talk about. And there's definitely a lot of research out there and a lot of data points if somebody's statistically inclined to go and dig into all that research. That's about it. One last thing also, when you do get into screens, and I'm glossing over quite a bit, but if people in the audience were to go out today and actually look for investments of their own, like one of the things I'm talking about with the mutual funds, reading the prospectus, one of the things you're going to come across is, like I said, how they're being applied, how the social screens and the social issues are being addressed. One of the things early on when I'm talking to clients or to prospective clients, we fill out an extensive questionnaire. one of the considerations that you have to have is, like, let's say you do not want to invest in the defense industry. One of the first things that always come up is a company like Coca-Cola. What do we do about Coca? Coca-Cola sells a lot of Coke to the United States military, a lot. Does that mean for you as an individual investor that that's violating a defense contracting screen? Are they part of the defense contracting industry? And so there's a lot of shades of gray whenever we talk about any of these issues. I have full faith in the organizations that provide the data. I think the analysts do a great job. However, there's still that personal preference of every investor. And one thing I notice with my clients, the clients that are more flexible, have fewer values that they want to have screened on their investments, are more successful with their investment overall. I think a strategy that I've seen be very successful is kind of a greening of your investments, but not necessarily an all-out, perfect, pure investment. So just want to leave you with that. I think that's something that we can talk about. It's kind of the nuts and bolts of actually getting your hands dirty in this that I can talk about with you guys. So with that done, I'll hand it over to Pierre.
Thank you, Brandon, for giving a panorama of what's been traditionally accepted as being the modes, the ways of investing money in an SRI fashion, socially responsible. Before I go into describing the various styles of SRI, I'd like to ask you a question. The title of the session is about where should I invest my money? So two scenarios. Either it's your own personal fortune that you want to manage, in which case, of course, you will want to look for the best returns. And if you have very deep inside moral values that are really dear to your heart, that you like avoiding in your portfolio so that you sleep better at night, then fair enough. I mean, if you have something against alcohol or tobacco or contraception, animal testing, nukes, whatever. I mean, you may have a whole range of values, and that's what has been traditionally accepted in the U.S. as negative screening investing. Now, if you are going into that space and you are asking yourself, okay, we know the demographic of the planet, we know about the plundering of natural resources, we know about abuse of human rights in emerging markets, we know about the side effects of globalization, we know about environmental liabilities, we know about a whole range of issues. And then most of you guys as MBA students at Stanford and other leading business schools, you'll have managerial position in industry. Chances are your money will be investing, your savings will be invested in a pension fund. Chances are you will be professional money managers managing the money of your pension funds. And then you want to make sure that the world is evolving in a direction that is sustainable. So the whole concept of sustainable development, of eco-efficiency, of corporate social responsibility, at the end of the day, financial investments are a very powerful lever to affect changes. And at the end of the day, what is perhaps the most needed out here is being able to leverage your money to exert, to apply financial democracy and affecting changes on corporate behavior, so that at the end of the day, not only in the next 5 to 10 years, but in 50 years to 100 years, your children, grandchildren will still be living in a planet that would be nice to live in. Okay, so I'd like to broach upon the various styles of incorporating those values and what has been the evolution of SRI in the last 40 plus years. Starting at the left corner, we have what is traditionally held as socially responsible investing, which is still the bulk of investing in the US in SRI. Clearly, that's a niche. The figures we talk about are 10% of asset under management. If we say that in the US, there are about $20 trillion worth of asset under management invested in large cap equities and even mid cap and small cap, but in equity investing. SRI, as we know of it in the US, as it's frequently referred to, is only 10% of it. And if you look at the pie, most of it is in negative screening. And counting into that would be all the funds that have at least one single criterion of negative screening. Could be no tobacco, and that's it. That would qualify. Now, those funds in the U.S. embracing the full scope of sustainability including governance issues, environmental issues, social responsibility, social issues, human rights. I mean, the slice of that pie would be perhaps less than 1%. Okay, so if you invest, that's quite a good thing that you would want to invest with your values and say, well, absolutely, abhor nuclear industry. I think it's something that has no place in a sustainable future. And then you make sure that you find an advisor who will implement your strategies and screen out those stocks. Now, if you want to affect corporate social responsibility at large, what you may want to do is to consider that the world is made of a whole range of industries. At the end of the day, we'll move towards sustainability. It's kind of a lofty goals. Chances are we won't move to sustainability in quantum leaps. And sustainability is not even in absolute terms because the factors are evolving continuously. And what was sustainable maybe 100 years ago may not be today because of the sheer volume of consumers. India, China, all want to access to energy, all want to own a car. And then if you apply the same ratio that we have, for example, in the US, you'll find that we'll need 5 to 10 planets in order to sustain us. Okay? So, what are the options considering those parameters? If you want to affect the remaining 90 to 99% of those funds, or the mainstream, towards engaging with the companies so that those companies will unleash the market forces. You know, this brilliant economist, Adam Smith, who had the proverbial green invisible hand, the invisible hand. Now, what he omitted in his thesis is the fact that there are many externalities that are not factored in. So what we believe is needed is to find a way to unleash those market forces to see to it that those corporations start competing not only for capital, for customers, but also start competing for having the best social responsibility. And that's something we've seen happening, and it's increasing. So year in, year out, those companies are vying to have a AAA with Innovest or to be part of a sustainability index to really show that they are managing their stakeholders better, that they are reducing the ecological footprint that they have, that they are better taking care of their employees, that they are innovating for the future, and a whole range of issues that I will discuss. So if you look at this curve here, we still have the bulk of it, especially in the US, but not in Europe anymore, focused on negative screening. Then in the 80s, you had a very interesting phase focusing on environmental technology. And those funds, they had a pretty high volatility. I'm not talking about venture capital. I'm talking here about investing in waste management companies, water companies, water utilities, renewable energies, maybe small cap. Those funds were very subject to the level of environmental regulations in the various countries. And obviously, environmental regulations fluctuate based on the political climate. So that was a non-diversified investment that was not conducive for massive investment from large pension fund and other institutional investors. Then you had 1992, the famous Rio Summit. And the large multinational at that time, they were really under scrutiny, and they were seen as the prime culprit. And actually, the corporate world industry is the prime contributor to environmental impact and certain level of social woes. And so the environmental impact needed a response from large business, and they organized themselves through various umbrella organizations to provide a response at Rio Summit, and then they coined the concept of eco-efficiency. The idea behind that is that corporations like growth, they like development, they like to increase the numbers. So with the concept of eco-efficiency, it's not only about reducing the size of activity, because obviously if they grow in size, they will consume more energy and they will produce more waste. The idea is building ratios, metrics of performance. Eco-efficiency is about producing more goods and services with less of an environmental impact. Okay, so traditionally what financial theory tells us is that in order to reduce the risk, we should diversify our assets. Okay, so if you take an index and if you start telling yourself that, well, I don't believe the oil industry is sustainable because it emits CO2, and thereby, I don't want to invest in that. Well, the sector contribution to the market cap of the index, I think, is above 10%. It's very heavy because those companies are large. So if you start excluding those sectors entirely, chances are your returns will be hurt badly because you will be taking too much of a risk compared to the index, which is your benchmark, for which a money manager is, held accountable to stay close to. Because if you take too much of a tracking error in investment, chances you're taking too much of a risk, basically. Especially lately, the oil industry has been performing pretty well because of the high prices and the lack of supply and security problems. So what I'm saying is that rather than perhaps excluding entirely a sector, that would be interesting to consider that perhaps the oil industry and those large oil companies, they will be the one having a lot of capital to be able to invest in those new emerging energy technology that will affect change going forward. So I don't see anywhere in the future those large oil and gas companies who are now relabeled themselves as energy companies to really fold their business, say, well, we no longer produce oil, the market doesn't want it, so we're out of business. No, they will invest towards the new emerging technologies, and they will shift their business model, still being energy providers, but perhaps that won't be based on oil. So really, if you want to affect change, because you're aware of climate change, what you may want to do is look at the coefficient of the oil sector and the other 60-plus sectors that you have in various indices, and to say, well, I want to invest in those best of the sector so that you will affect change. And if you come and you are a large pension fund, you're a money manager investing money for CalPERS or CalSTRS, and you say, well, I have a fund here, it's $120 million, and I'm an analyst, I'm talking to you, I'd like to see where you stand in terms of emissions of CO2, in terms of your investment in renewable energy, in terms of reducing your risk, managing your human resources, and so on and so forth. Then you start engaging this capital to affect changes. And companies start responding. I can tell you, they pick up the phone, whereas analysts, we say, well, we're advisors to so-and-so, such and such money manager, and start asking them for their CO2 emissions, for their energy use, and deep factors allowing us to do analysis. So that's investing in a coefficiency. That allows us to say, we're not about excluding anything. We're about picking the best in the sector and trying to match that with a portfolio so that we know that we are picking the stocks that have the least ecological footprint, the less risks, that are better managed, that have a better governance, and are better capturing what we call strategic profit opportunities. Then later, we had the social element of sustainability coming back to the fore in the field of corporate social responsibility. That's the social element included in the triple bottom line investing. So the idea was that sustainability is based on three pillars: economic, environmental, and social factors. So that led to approaches monitoring looking at a company from three different angles: environmental, social, and economical, financial. So that led to certain indices that are still in vogue, that are very interesting. It's about crossing various elements. But finally, where we are today, starting in the early 2000s, you have the concept that we develop being trying to integrate the various factors to look for materiality. If we want to be in a position to affect change across the 99% of asset under management who are not paying attention to sustainability factors, we need to demonstrate that those factors have a relevance to the share price. All those financial analysts, most of them have no clue as to how to analyze those companies. It's simply not on their radar screen to be asking for their waste production every year, their energy use, their emissions of CO2 and other greenhouse gases. It's not there. So they are more focused on the short term. Whereas sustainability, we look typically at factors that would be important for generations to come. When we started in 97 analyzing companies and invest, way before the Kyoto Protocol entered into force. And it was ratified this year, early in February. Okay, we knew that those climate change factors will have structural impacts on companies and impacts on competitivity. So, of course, we're pioneers in raising the flag and telling our clients, well, you should start looking at these issues because they will be drivers of future performance. So the idea is, if you were at Al Gore's presentation, that's what they do at Generation. Of course, told us that he was kind of more or less the inventor of that. He invented the internet, as we say, but he made a really great speech. I mean, his angle on looking at those factors of the light spectrum, whereby when you look at the visual bandwidth is very narrow, and there's a lot of things out there. That's what we capture, but in a somewhat of a different way. We look at a company, when we look at a balance sheet, we look at what we call the iceberg balance sheet. Okay? If you look at it, if you take the entire market capitalization of, say, the S&P 500, you will find that the financial capital or the asset value is only no more than 30% of the entire market cap. And the rest is made of what? Is made of intangible value factors. Okay, so there's the willingness or the belief that a stock will perform. Okay, so there's a factor that is based on a lot of qualitative issues, a lot of belief in management, belief in intangible like intellectual capital, capacity of management. Wall Street analysts will tell you that the number one determinant of stock price is quality of management. Okay, governance factors, a whole range of issues that sort of make up the mind of an analyst and say, well, I think that company will meet its expectations. Okay, so that's the intangible value. You can monitor it. There's some experts who've done some research. You can really, for each stock, compute what is the amount of goodwill or intangible value. Now, the immersed part of the iceberg, as you know, actually it's more 90%, but here, that case is 70%. When we analyze those non-traditional factors of performance linked to sustainability, we look at factors of sustainable governance, environmental factors or the eco-value, the human capital, and the stakeholder capital. So, sustainable governance, you're all very familiar with all those scandals that happened and around WorldCom and all those companies, Parmalat, where a lot of frauds occurred. So these are failure in corporate governance. So that's the traditional aspects of corporate governance. And there's a bunch of regulations that are in place now for firms to have supervisory committees, supervisory boards for disassociating the functions of CEO and chairman, and a whole range of remuneration policies and board diversity and so on and so forth. So in addition to that, that's what we call traditional governance practices. In addition to that, we look at the governance of the companies relative to major sustainability issues. Take the oil industry. You have on one side John Brown at BP, who's been a fierce proponent of embracing global warming and even, rename his company BP Beyond Petroleum and all these campaigns, and that has led to many programs in place. So it means that the very top management has in its very DNA factored in the fact that, hey, climate change is there. The ice caps are melting. There's an amount of risk. There's a European emission trading scheme in place. Ton of carbon as a spot price now trading over €25, which is close to $30 a ton. We know that these things are important for our strategy. Let's not hide it. At the other end of the spectrum, you've got CEO of ExxonMobil, Lee Raymond, who's been in denial for many years. Okay, so that tells you a lot about the corporate makeup, the whole subconscious of the board. So these are the factors we measure: the strategic capability of addressing sustainability issues at large. Then the eco-value. We're measuring the environmental performance by looking at three dimensions. First, we look at the the environmental risk, then we look at the environmental management and the capacity of the firm to manage those risks, and then we look at the upside. We look at what we call strategic profit opportunities, which are ways of measuring the innovation capacity of a firm, what they do to develop new line of activities that are really positioned to capture those sustainability drivers that are mounting, and capturing and getting a leading edge in being the first to innovate. Casey's point, an illustration I would cite Toyota. A lot of firms have been talking about the hybrid powertrain for a long time, but Toyota and Honda were the first to put it to the market. Okay, so at the beginning, everybody in the industry said, I don't believe it. You know, those cars, they cost $1 million to manufacture. They're losing a huge amount of money. It won't last. Well, guess what? Now they are selling hundreds of thousands, especially with the oil price right now. But it's poised to continue. And all the other firms, 10 years later, or not even 8 years later, they are trying to do the same thing. But they realize that, hey, it's not that simple. Toyota Prius, inside of that, the technology is very advanced. Ford told us about 5 years ago that they were about to release the Escape. It only came out this year. And then they had to license the technology for Toyota to be able to do it. So that tells you a lot about the innovation capacity. And so Toyota understood that in the same way that they enlarged their market share by focusing on quality in the 80s, and that's how they really managed to grow their market share, because their cars are selling at a premium for quality. They understand that the new driver for the next 15, 20 years, and perhaps more, is the environment. And they were early at capturing that. So through our analysis, that's what we're trying to capture by looking at strategic profit opportunities. Then we look at the human capital. All that has to do with the quality of life of employees and those who are on board. So we look at things such as recruitment and retention strategies, employee motivation, labor relations. Do the employees have the right to assemble? Innovation capacity, how the company managed to translate its own vision and mission to align it with employees' motivation. Knowledge development dissemination. Health and safety. Health and safety affect really the morale of employees big time. If employees work in a factory where there's a very high rate of accidents, obviously that kind of scale and not really motivating environment. And progressive workplace practices. So all those factors are fairly qualitative with some quantitative analysis whenever we can. But I would say that it's less conducive to quantitative analysis than the environment, where we can really monitor hard data, do precise benchmarking on eco-efficiency factors. Then we look at the fourth pillar, fourth driver of intangible value, stakeholder capital. Now, stakeholder capital, it's about how the firms relate to the outside world, including regulators, its consumers, its suppliers, the communities where it operates, and especially issues in emerging market, where typically the standards of corporate performance are not as high as they are in developed countries, so there are more abuses of human rights. And those factors have a very high potential for hurting the brand value or brand capital of a firm. So in that, typically an issue that we'll analyze under that section is how the firms react and behave in the case of an accident or a mishap. I'll give you an example. In 1997, in the oil industry, you had Shell. They had a platform in the North Sea, west of the coast of Norway, that reached its end of life. It was Brent Spar. It's an oil storing platform. Because we're at the end of the life, they say, well, I want to maximize profit for my shareholders. What's the cheapest way to end that life cycle? And they decided to sink it to the bottom of the North Sea. And guess what? Greenpeace came around, say, well, campaign. The Earth is not a garbage can, so you can't really sink it there. And they started to do a heavy campaign. What you've seen overnight in Germany, German consumers started to boycott Shell gas stations. Overnight, Shell lost 80% of its market share. No, 30%, sorry. They lost 30% of market share and it took them 18 months to recover it. So at the end, Shell had to throw back the platform and dismantle it. It cost them a fortune to do that. And what we learned later, it's quite funny, is that actually Greenpeace, they didn't do their sampling through the right pipeline. There's a lot of pipe, and they did some testing and say, well, look at these emissions coming out. But it turned out they analyzed the wrong pipeline. That was a fitting where there was some drippings going on. But it doesn't matter. At the end of the day, that's the power of civil society, that's the power of NGOs over large corporations. So if you, as a manager, you manage your firm and you're in firm denial, chances are the stock price will reflect that very quickly, drop, and then it will weaken the position of the firm. An example, Perrier, a French company in the food industry, and they had a contamination through benzene of their waters. And they were not equipped to manage the accident. It was in the 80s. And then, so it was a big scandal, food contamination, and it was a real panic, and it took a long time to remedy to the situation. And their stock price dropped so fast, dwindled to the point that they were weakened and they were bought up by Nestle. And there are many examples like this where companies don't recover after an accident. So these are the stakeholder capital factors. Okay, so key drivers to integrating or to factoring the sustainability issues into share price development. Why those sustainability issues are poised to stay and remain and intensify their repercussions on their corporate performance. Well, if you look at the economics of the world, you look at the developmental trend, you can see that the environmental impact is accelerating. And regulators are trying to find the right solutions, at least in Europe and Japan and other parts of the world, to address many of those factors. I'm talking about climate change. So when you see those tougher requirements, obviously the companies have to innovate. They have to be earlier at finding solutions so that they can really operate under a more constrained world and be more responsible and reduce their risks. But also in the financial industry, what we've seen in Europe is sort of an institutionalization of this concept of social responsibility. Now it's sort of a given that social responsibility includes those factors of governance, social responsibility, and reducing environmental risk and impact. So more and more you've seen in the last 5 years, we've seen an increasing number of RFPs, request for proposal, when pension fund money wants to be invested, has an element of the RFP, the fact that they want their money to be managed with some sustainability principle. And it's happening also in the U.S. We've seen a recent trend in RFPs in the U.S. from CalPERS and CalSTRS requesting bidders, money managers, to integrate principle of environmental responsibility. Okay? So we even have regulations in Europe where pension funds need to disclose the principle they've adopted as their guidelines for managing their money. So in truth, what we see emerging is that we have a shift from the niche market of SRI, negative screening, which is respectable. If you have principle, you should ask your money managers to apply them. But if your money is managed to a large pension fund, I encourage you to go and ask the money manager if they have any products including factors of sustainability, because what you want to do is to have your money that is managed in such a way that it will steer the economy towards a sustainable path. So you want money to work for you both from a financial return, but also from an environmental and social dividend, if you will, sustainability dividend. Okay, so now what is at stake is no longer so much the ethical or values-based principles, but it's also the very fiduciary responsibility of trustees. Because when you have issues such as climate change, which are demonstrated to be able to impact the share price, the shareholder value of a firm, not looking into those factors is not fulfilling the fiduciary responsibility. And we've seen a number of coalitions in the US and across the world that are trying to raise the question and put pressure onto pension funds and fiduciaries to really start looking into those issues. One very powerful initiative in that space that took place over the last 4 years, that's the CDP, the Carbon Disclosure Project. I don't know if you're familiar with that. It's a coalition. Today, the third report has been released. The idea is to enlist institutional investors behind the risk and the cause of climate change to interact with the Fortune 500 firms. And so you have a coalition of representing $20 trillion worth of assets. And collectively, they've sent a letter to the CEO of each of the Fortune 500 companies saying, we are investors in your firm, collectively represent $20 trillion of assets. And so as investors, we'd like to know if you consider climate change as a risk, as a financial risk to your firm. And if so, to what extent? What are you doing to curb it? What is your current level of direct greenhouse gases emission, indirect greenhouse gases emissions? What is the market risk to your firm? How could it impact the share price? So that's kind of a very powerful way of unleashing capital markets towards steering the agenda and having companies acting to really becoming more transparent around these issues. And that's happening and that's accelerating. So at the end of the day, why those sustainability factors do add value to the share price? Now, environmental, social, and governance performance, they touch upon very important levels of performance within a firm. Stakeholder relations, we've seen the power of undermining the brand value of a firm and how the intangible value is very linked to the perception of customers and how quickly the brand value could be deteriorated through an environmental or social accident. Aspects of cost liability reduction. Typically, eco-efficiency is about reducing or increasing energy efficiency, material efficiency, in other words, producing the same but with less waste, more recycling, cutting consumption of water, and producing that at the same quality. And what we see is that it's cutting costs. When you have the price of energy, both gas, oil, that high, well, guess what? The energy costs are a very importable share of operating costs in the large impact sectors. But also on the whole image side, human capital is very important. When you are looking for a job, I mean, would you feel interested in working in an industry from the past that is still fossil, that is entrenched in this old way of thinking, that keeps polluting and saying that's the best way to give a return to shareholders? I guess not. You may want to work for a more progressive firm where they will try to embrace the challenges of the future, innovate, and try to change their image and try to steer their business model towards a more sustainable direction. Market share growth. We've seen those aspects really interacting, helping companies to grow their market share. We've seen that with Toyota, which I talked about. Innovation capacity. Well, typically, those sustainability drivers are very complex factors to manage, and they are putting constraint on companies, and so they need more R&D. So there are two ways for companies to address sustainability challenges. Either they put lawyers on the case. That's what GM did by suing the state of California to prevent them from keeping their regulations on specifying a certain percentage of electric cars, versus putting the engineers to the plow to devise new technologies. Well, they could do, but they chose the other route. So that's the kind of elements we look at. Elements of time to market reduction. So all these factors are very mainstream. They are really part of your business management textbook. And by looking at those factors in a systematic manner, sector by sector, it allows us to really capture a differential of risk exposure and quality of management and positioning towards strategic profit opportunities. Back to the climate change issue. In some industries, like the electric utility industry, in the US only, what you find is that the level of risk exposure to climate change vary from 1 to 20, by a factor of 1 to 25. So the most exposed firm are 25 times more exposed to the others. So of course you can build scenarios on what would be the price of a ton of CO2 in the future. That's the kind of scenario analysis that we do that allow us to determine what is the share price exposure to those carbon risks. And overall, what we're trying to measure is the materiality of those social and environmental issues. And what we've observed is that those factors, if they are analyzed the proper way, it's not simply just digging facts, putting them, throwing the balls in the air and expecting that you'll improve the return. It's about analysis. So you can have a whole range of indicators or raw data that you take out, but the difficulty is really understand and analyze how these could affect the share price at the end, how material these issues would be. And that's what we're trying to do, and that's what many more analysts are trying to do. We've seen a whole range, a whole initiative, actually Algo mentioned that, the Enhanced Analytics Initiative, started in Europe. What it is an initiative to unleash analytical power from the sell-side analysts. All these investment banks, Citi, UBS, Merrill Lynch, and many others, who typically produce sell-side research on financial aspects, to also look into those sustainability issues and how they could really impact the financial performance. And so what the AEI does is that it's a pool of money that's actually 5% of all their transactions that are being directed to those brokers that are providing the best SRI research. So in the last 2 years, with the help of the UNEP, United Nations Environmental Programme, Financial Initiative, there's been a whole pool of thinking to try to ask the big question with the mainstream, how those sustainability factors could be relevant to share price performance, how material they could be. And so you can, if you dig a bit, if you go to UNEP-FI website, you will find a lot of those studies, and that's fairly enlightening. Not that they are having the full picture. Sometimes we're professional of analyzing sustainability, but these guys are professional at analyzing financial performance. So the beauty of the exercise is that they are really capturing those factors and bringing that to the mainstream. And then, so when you see those reports from Goldman Sachs or Citi, Merrill Lynch, UBS floating around, you have suddenly big names. Those guys have more than 200, 400, 500 billion dollars under management. A huge institutional money. And then they start raising those questions. So then they start getting interesting because the name is, sustainability factors become mainstream. And so to the point that, I would argue that the paradox of SRI is that at the end of the day, we'll be better off when there's no longer need for SRI, because the whole money under management will be managed with those factors of governance, environmental and social parameters that make, that will be part of the corporate makeup and the financial analysis of all those money managers, so that they can steer the investment towards those companies that are doing a better job at limiting their risks. So does that work? We heard the question before, whether or not it is true that we can add value by looking at those sustainability factors. Now, again, one of the difficulties we have is that we're typically looking at factors that are long-term. We have a long-term horizon, whereby financial analysts have a short-term. So the difficulty is to really materialize this and to really zoom in the lens and find the right time perspective. But overall, in the last 10 years, out of 70 separate studies from academia trying to look into the correlation between environmental social performance and financial performance, there's about 50 studies that show that there's a positive correlation. 10 studies show there's no correlation. 10 studies that say it's neutral, and about 7, 8 that say it has no correlation. Recently, the Moskowitz Prize, that is an annual prize that is awarded by the University of Berkeley with Lloyd Kurtz to reward the best study, has been awarded to some students from Erasmus University. Her name is Nadia Gunster, and she actually used Innovest data on eco-efficiency to try to look at the link between environmental performance and financial performance. And what she found is very profound. Over the last 7 or 8 years of data that we provided, she found that overall we added value, and it mostly added value by way of avoiding those companies that had lower than average environmental performance. So, I mean, this is the kind of data, substantial, that will, find its way on the table of money managers, and obviously try to change their way of thinking. So back to the various styles of how we can apply those sustainability strategies to a whole range of asset classes. As you know, pension funds, they do tactical allocations, so they have money in fixed income, in equities, in small cap. They diversify regionally, and some even have money into cash or even hedge funds. So actually, the good news is that you can apply a sustainability overlay to any style of investing. So starting from fixed income, fixed income, if you rate an equity, you can also apply your rating to a bond, even though the dynamics is a bit different. You can have active strategies, stock picking. That's the strategy that Algo presented for Generation. A very narrow portfolio. They had 35 stocks. So you can be active with a quite sizable tracking error to more with less risk by taking an enhanced index. So what it is, you take an index, say S&P 500, and you are tilting it. So you take more of a bet on those stocks that have rating above BBB from Innovest, and then you are underweighting those who have a rating below BBB. So it's not a pure play sustainable fund of sustainable companies. It is using this extra financial research to add alpha, to add perspective to your investment strategy, and making the performance of your fund more robust on the long term. But you can even go further. Private equity, that's a very, very interesting area. There's a number of panel sessions that took place here on clean tech, and that's growing, and it's a very good thing because it's really unleashing capital markets to invest and grow those technology that have a huge potential. And you even have hedge funds, alternative, absolute returns firms, who are trying to be more socially responsible. I mean, that's questionable whether or not it is. I'll leave it up to you to determine that. But it's some have applied our research to make a long-short hedge fund. So longing the AAA and shorting the CCC from Innovest. Other interesting elements for you to grasp whether or not we can add value. Whenever we analyze a sector, because it's really sector by sector, we don't analyze a bank with a chemical company, with an oil company. So here you take textile and apparel. We are charting the performance of the stocks that are rated above average versus the ones that have a below average sustainability rating with us. And what you see, the differential in yellow, that's the share price differential of those two portfolios. Now, in textile and apparel, we found a 23% outperformance over a 3-year period. Food and drug retail, 25% outperformance 3 years. Food product industry, 32%. European electric utilities, 33%. With a certain amount of volatility. It's not perfect, but you can see that there's raw materials to apply to a very well risk control fund management strategy. We've done other tests on various investing styles with U.S. money managers. It was for a large U.S. pension fund. U.S. large cap growth, U.S. large cap value, international large cap, so on and so forth. I will skip the details, but it's about looking at the effect of giving taking the risk using our research versus what would be the return on investing. And what you show is that every time, each bar is like you add more of the signal from our ratings. Every time these strategies are beating the benchmark. So that's very good news. And what we, of course, want to see is that those trends will hold over the years. And some of the funds that are using our research, Green Planet Fund, that's managed by French money managers from quite a large institutional player. So that's the Green Planet Fund that is using directly our eco-efficiency analysis, our eco-value research into a fund. That's showing with a very small risk-taking, it's showing that it's beating its index, the MSCI World. Others, it's a Spanish one here, and we could go on. But those funds exist, and what they need is people like you to create the demand. Whenever you have your money invested, ask what are you going to do with these funds. I mean, not to rule out those negative screening. I think they have their place, their role to play. They're doing good things. Some money managers will tell you they will be hurting performance, and they may. But look for sustainability investing, way of looking at this broad scope of governance, environmental, social issues to drive the behavior of corporate performance and practices. So I think